it is said that subprime mortgages contributed largely to the crash of real estate in 2007 and 2008. Now they're back under a different name. The question is history doomed to repeat itself, or are they different this time? Okay guys, so first things first, let me touch on the fact that I'm not a lender, I'm not a banker, I'm not a financial expert. I'm just a guy who did a research paper on subprime mortgages for college and has invested in some real estate, so I have a understanding of how things work. That being said, this is my 2 cents on the now non-prime mortgage industry. For those of you who don't understand, subprime mortgages that were largely accredited for the crash of the market back in 2007, 2008 is basically saying that if you can't afford a property via conventional lending methods, we'll give you this higher interest loan anyway, and we'll let you work with it as long as you can make the payments. So what happened is people had these mortgages and they were adjustable rate, and all of a sudden the rate would go up. They couldn't make their payments, and bada bing, bada boom, no more house. And then as that started to happen, the mortgage market got shorted, and there's actually a cool movie on it called The Big Short. You should check it out. All these people lost their homes, and then the market real estate value went like that number. So they're back now as non-prime mortgages, and really the only difference is that, from what I can tell, is that subprime mortgages are not kosher, but non-prime hasn't been deemed unkosher, so we're gonna rename it, repackage the same nasty meat, and call it a new burger. Yeah, we'll see how that works. Some of the potentially dangerous lending criteria that these loans encapsulate are things such as they're going to lend on people with as low as a 560 credit score. Traditional mortgages go to like 620. They're going to loan on people that have up to a 45 or 50% debt to income ratio, which is insane. I mean, you shouldn't be over like a 30, theoretically. So if you're at 45, 50, you're probably struggling financially anyway. Now you throw this overpriced mortgage on, it's not going to go well. The justification being that millennials traditionally carry more debt. I think all of this kind of goes into as people start talking about minimum wage hikes and not hikes and this, that, and the other, I think a lot of this all needs to boil down to cut your expenses, right? Like we're sold this life of living the dream, and in order to live the dream, we need to have all these things, and man, that consumer mindset is going to start hurting people. But that's another video for another time, probably like 4 weeks down the road. The point here is that if you have bought all this stuff and maxed out credit cards and have a higher debt to income ratio, and in doing so have not necessarily made all your payments, so your credit score is not very high, you still could qualify for one of these loans, and the bonus is a higher interest rate. So that's, I see that as a dangerous lending criteria, that you may not be that great with your credit already, so we're going to lend to you. In theory, and the way that it's marketed, these mortgages are kind of targeted towards like self-employed, those who don't have a W-2 and it's hard for them to prove their income, but they might have plenty of money. So the theory being that they would have to put down 20% or even 30% sometimes for these loans, and that would prove that they are making enough money to carry the weight of this mortgage. But reality is, as you read into a lot of the loopholes and widgets, that it really does seem to be accessible to people who really don't have any business over leveraging a mortgage like this. Another monstrous kicker on this is that to help the payments be more affordable, they are talking about increasing the loan term from the traditional 30-year loan to a 45 or 50-year mortgage note. For those of you who've seen kind of the car industry lately, people have gone from like the traditional 60-month or 5-year mortgage payment. They're doing up to, I've seen 8 years. I've heard 9, but I haven't seen that. But 8 years payment for a car. And the justification that people think is, oh, well, on an 8-year note, I can afford a more expensive car. And that is absolutely the wrong ideal. So these people are going out and they're buying this car that I can make a $300 payment. Well, let me buy a $50,000 car and drag it on for 8 years instead of 5 years. And it's just sucking you into paying more interest and just being in debt longer. And it's terrible for the consumer. Now imagine if you get stuck into a loan on a mortgage for 50 years. So Obviously, the chances of you staying in that house for 50 years are like slim to none. People rarely make it to the 30-year payoff, let alone a 50-year payment payoff. And you're not going to expect a 25-year-old person to say, "Oh, I'm going to live in this house till I'm 75, and then I'll just buy another house." Like, that's just not how it's going to work. The scary thing with this is that by making it a 50-year note, the amount of principal that you're going to pay off over time is just ridiculously little. So you might have this house for 10 years and only have paid off, in theory, 20% of the principal, but with the way amortization works, it might only be like 10 to 15% of the principal. I don't know about you, but buying a $100,000 home and then only paying off 10,000 of it in 10 years, that's just not cool. Even if it was paid off 20,000 of it in 10 years, that's just still not cool. So I implore you, don't go looking for a 50-year loan term. In theory, you could refinance out of this loan or you could pay it off faster, but the reality is that most people aren't going to be doing that. You're just asking for trouble. Buy a 30-year loan with normal rates that you can afford. And if you can't afford it, then rent and work on your expenses and save up. In a mortgageloan.com article that I read, it goes on to state that in theory, a person with a 580 credit score could start out with a 7% interest rate. The trick here is that those aren't fixed rates. So imagine paying a 7% interest rate on a $100,000 home. So you're paying, I'm not going to do the math on TV for you, but keep in mind that 4 to 5% is normal. So you're paying 2 or 3% extra in interest, and then you max it out to 50 years. And then, oh, by the way, as the interest rates climb, which it's slowly starting to do now, if you haven't noticed, your mortgage rate's going to climb. And I'm just saying that's exactly what happened last time, and people weren't able to afford their payments. So, so far we're on the history repeats itself track, but let's see if we break that. Okay, so another big kicker in the past was that they weren't even verifying employment. You could just write on a piece of paper what you made, and they would accept it. I believe they just called it stated income. So you just state what your income was, and voila, you qualified for a loan back in 2005, 2006, 2007. So now they require you to verify employment, but realistically, what a lot of these banks consider verifying employment is just seeing your bank account statement to show that you have money in there. I'm not saying that you should game the game, but it's possible to game the game here where, you borrow 100 grand, put it in your bank account, and, maybe you let it sit there for like 3 months, and then all of a sudden, oh, look, I make this much money, and here's my bank account. Now, I don't think that's the case, but just keep in mind that if the banks are looking for non-prime loopholes to bring these loans back into the world, the odds are that people are going to be looking for loopholes to, be able to buy their dream home. It's just, I don't know, something feels iffy. All right, not that this is a red flag or anything, but another thing that is kind of crazy is they're not taking past bankruptcies and foreclosures into account. So you could theoretically have poor payment history, foreclosures, and bankruptcies in your history and still qualify for one of these loans. Obviously with that, you're still going to have to meet, like the year timeline before, like 7 years or whatever it is after foreclosure or bankruptcy before you can qualify for a loan. But I'm just saying, if you've had a bankruptcy and a foreclosure and you have terrible credit still, odds are that you shouldn't be dabbling in a more expensive loan, but apparently that's acceptable. Now, it's still very early in the non-prime mortgage industry game, but some of the articles that I've seen around the internet are stating that like 90% of the people who apply get accepted. That's way higher than most conventional loans. So you're saying that the people who can't qualify for a conventional loan can now turn around and at a higher rate qualify for a more expensive, lengthier, and just all around riskier loan, even though they couldn't qualify for the better, safer one. That just doesn't make sense. That is basically like me saying, hey, you can't buy this Ford Focus because, I just don't like how your bank reads. But there's a Cadillac over here that I'll give you at a higher interest rate, and you can definitely afford this one. Who wins here? Banks or homeowners? I think you know the answer. All right, guys, so have we learned from our mistakes and setting these up in a way that are better than the first time around? Or is history going to repeat itself and this is going to end very badly? Now, obviously, I don't have my little crystal globe here to tell the future, but I will say that we are opening the floodgates to people who have low credit, unverifiable income theoretically, history of late payments, foreclosures, bankruptcies, and just all around people who have not had good track records with their money and lending to now qualify for just a riskier loan. I don't personally foresee this going well. I can't predict the future, but I would ask that if you're looking at a non-prime mortgage, talk to somebody who has some experience with getting qualified for loans. I have some friends I can recommend you to. I have some experience with creative financing. I have a lot of friends who have experience with creative financing. I would definitely say that it is less risky to go with the creative financing route, like seller financing and stuff like that, than it is to go for the non-prime mortgage. So I implore you that if you're looking at non-prime, make sure you have at least a year's worth of payments in the bank, and make sure that your job is something, your skill set is something that'll be employable, because we don't really know what the future is going to hold. The stock market's kind of starting to level out and blip, and people are starting to, worry. I don't think this is going to help. So just do your due diligence, be safe, and do some research. Hopefully we are not about to repeat history, but I wanted to put this out there on the web so that if it does happen, I can at least have tried to help, because I don't foresee the non-prime being a good lending option for most. So be safe out there, guys. If you like the video, go ahead, comment. If you think I'm wrong, comment. Tell me why. I'd like to hear it. I'm not a lender. This is my 2 cents, so let me know what you think. And then, subscribe, hit the little bell so you get notified about more content, and we hope you have a great day. Thanks, guys.